some of the things that we've talked about. I know you don't like to call yourself a bear, but as far as like your stance on where we're moving, it sounds pretty bearish. What are you like?
Okay, look, I am market agnostic. I'm neither bear nor bull, but I will go where the money is. And if right now the money's on the short side, and I think that the markets are going to come down substantially over the next 6 months, year or two, then I'm going to be on that side. That doesn't make me a bear. That just makes me a capitalist because I want the money. Afterwards, when we've gone through this, then I'll turn bullish again, and I'll go, okay, now it's time to bet the farm on the emerging markets and everything else.
Yeah.
But right now, for me, I think that we're due for a correction. I mean, this market's gone way up, and yeah, it could go to 11.2, 11.3. I don't see going, as I said, I don't see going past 11.8 because that's a really strong resistance level in the Dow. But for the time being, yeah, I am bearish, and this is kind of weird. If I say to someone, I can make you 70% a year, oh wow, you can walk on water. But if I say to you, hey, if you do this, you'll save 70%, because I think the market's going to drop, and I'm just using that as an arbitrary figure, then people think I'm crazy. You guys don't want to hear bad news.
Yeah.
Even if you can make a hell of a lot of money in it, you don't want to hear it.
Where are the opportunities then? Like, are we talking about, like when you say save money, like that, I don't think, and I'm sure you agree, taking your money and then hiding it in your cistern or under your bed is also not a solution.
No.
So where, in 2010, where do you see the opportunities?
Okay, well firstly, I'm on the deflation side of things, not inflation. I don't think all this government money is going to create inflation. I mean, if you could create inflation by printing heaps of money, Japan would be in mega inflation right now. But they've had 2 lost decades and they're in deflation.
Yeah.
And the problem is that you can be right about this and go, oh, the markets are going to hell in a handbasket, but I think that the result of that is going to be inflation. And then even though you got the market direction right, you'll be wrong because you'll lose money because you'll be in the wrong asset classes.
Yeah.
Whereas in an inflationary environment, commodities do well, stocks do well, everything else does well. Cash is a poor investment and bonds are generally poor investment because the rates are so low. But in a deflationary environment, every asset class goes down. Commodities lose value, houses lose value, stocks lose value. The only thing that retains its value is cash. And that's because the cash can buy more of the deflated investments.
Yeah.
So the guys going into gold right now thinking it's going to go to 5,000 an ounce are probably going to be pretty severely disappointed.
Yeah.
You know, because if you did convert everything from US dollars 6 months ago into gold, well, yeah, you've had it rally and it's done quite nicely, but I basically believe that gold's going to start heading down. Our target's probably 650, 680 for gold.
Yeah.
Which I know isn't impossible, but you know, when I get my grandfather ringing me up telling me he wants to invest in gold, and when I see Harrods of London selling gold over the counter, and when I see central banks buying gold, central banks are really bad investors at the best of times.
Yeah,
when I see them doing that, I go, hang on a second, guys, gold's got to go down.
Yeah. Sometimes going for the completely contrarian type of investing works well. Most people are wrong.
If 95% of people are broke by the time they reach retirement, shouldn't I do what the other 5% do?
Yeah, the opposite. So as far as like opportunities, like you again just went back to the idea of, well, cash is something that retains its value, but again I still feel like, well, it isn't, I see with my background as holding cash as effectively doing nothing, like sitting on the sidelines.
That's because you've grown up in an inflationary environment where inflation erodes the value of cash.
Yeah.
But we're going into a deflationary environment, potentially, okay, not advice, but we're going, sorry, it's a broker in me coming out, but we're going into a deflationary environment where cash is going to be worth more. At that time, you look at, well, first, whatever you're in, there's nothing wrong with whatever you're in, as long as you've got an escape plan.
Yeah.
You know, as long as you've got stops in place, it doesn't matter.
Yeah.
Okay, so, I mean, the market can keep rallying, so you can be long for a bit longer, potentially. For me, I want things that generate a cash stream, a revenue. Businesses will do good if they're good businesses. It's all about having a revenue stream and generating revenue.
Yeah.
Okay, for an investor, I like the short side. I mean, I love the ETFs because I'm lazy. I don't want to work out which options contract I need or what series I should look at or futures and that. And that's just me personally. I like the ETFs because I can do the You know, the 1-to-1s where I can do the leverage double, 1-to-2 or triple leverage and things like that.
Yeah.
And I like them because I can go the short side and be on the short side and then make money as the market falls. Now, that's not saying I'd rush out now and do it, because I think in my last newsletter I showed that back to about the 1800s, 97% of all market movements could be attributed to the trend.
Yeah.
So I'm not going to jump in front of a bus right now and say, hang on, I'm going to go against the trend. That'd be so stupid.
Yeah.
But when I do see, and this is what I do in my newsletter, and what I'm starting to put in now, a signpost saying, oh, if the Dow closes below X, then this could happen.
Yeah.
So that it's okay. The trend's up now, but if it closes below this amount, then maybe you need to look at things differently.
Yeah.
So looking at warning sign, then confirmation at this level, and then we go short. I mean, I showed in my last newsletter, just basically I said crystal balling, saying okay, $10,000 invested in this triple leverage ETF when the market turns down could be worth this, and then after that point we get another turning point, and then we go long again, and the potential over a 5 to 7 year thing being extreme could be turning 10,000 into 200,000.
I think that's one thing that I do like about your methodology, as far as especially understanding that there is a disconnect between what the economy is doing and what the market's doing. The idea of, well, here are the facts, let's look at the facts, try and get an idea as to the general feel of the economy, because that'll ultimately flow through, but then more of a reactionary. There's no point in trying to pick the top or the bottom, wait for that turn, make sure you've got your appropriate stocks, you're trading with the trend.
Yeah.
And the way that you see it, your underlying feeling is in 2010, the trend in a lot of asset classes is going to be down, but there's always going to be opportunities.
Yeah, well, that's just it. I'm not saying hide your cash or bury it in the backyard. I'm not saying anything like that. There's going to be a heap of opportunities. And the thing is that if it is a huge, well, at the moment we're in a bear market rally. It's still a bear market as far as I'm concerned. And look, I'm going to keep thinking that until I see something that changes my mind. And I haven't seen that at the moment. Yeah. So I'm going to keep looking for opportunities. And there's going to be a lot of opportunities. And if it is a bear market now, and we do have these huge corrections, they happen much faster. So we can make money a lot quicker than we can in a bull market, just sitting on our hands waiting for stuff to happen.
Yeah.
I think the ratio, I think, is markets fall 7 times faster than they rise. And that's great.
Yeah.
Not so good if you're long.
If you're on the right side of the market. Yeah, for sure.